Hey folks, and welcome to this symposium. Today we're going to talk about probabilities, and this is a topic that is very relevant in relation to trading. Okay, so I had a conversation with a good friend of mine from the UK, a gentleman by the name of Mark, and we were talking about random events, binary random events, binary as in you can have two outcomes from a random event, which is essentially what we have when we talk about trading. Trading can have two outcomes. We can have a winner or we can have a loss, so that's a binary event, either or. And something that was really interesting is that if you consider a random event such as coin flips, like we have here, notice that we do not have an equal distribution of zeros and ones. Okay, so it's not a coin flip, but it's it's generation of either one or zero randomly. And we do this 100 times, and then we chart how many ones we had and then how many zeros we have. And we show these on the line below. And if we just do this, you can see we had 59. Wow, that's a huge skew. That's rare. So if we say that the ones are winners and the zeros are losers, we had 59 winners and 41 losers. And notice how the ones, the winners, cluster together more times than not. So we had winners, we had losers, they cluster together, winners, a big cluster, a big cluster. And so this is happening a lot. And so knowing this, we can take this and we can apply it to our trading model. We can't really use it for an entry signal, but we can certainly use it when allocating risk to a given trade. And the reason we can do this is because if we experience a winner, a one, then we know that the likelihood of another one, a winner occurring, is slightly greater, probabilistically significantly greater than it being a loser. So knowing that, what I've built into the robot is the functionality that takes the risk from a winning trade, not the risk, the profit from a winning trade, and it allocates it to the risk of a following trade, because the likelihood of the following trade being a winner is ever so slightly greater than it being a loser. Okay, and so when we do that and we base the entry on a random event like this, where we have this essentially is looking for a random number, and it is checking to see if it is an even number. If it's an even number, it buys. If it's an odd number, then it sells. So the entry is completely random. Okay, so the stop and the target, they are based on the range for whatever time frame this algo is run on. And so if we take this and we run it through a back tester and we say, I want you to take the profit from the previous trade, and I want you to allocate it to the risk of the following trade. Okay, and I want you to start at 10%, 10% of the profit of the previous trade, and I want you to go up 10% until you get to 1%. 100% of all of the profit, so 1 equals 100%, obviously. And then we have stop, multiply, and we have a risk reward. And so here we have, this is essentially a 1-to-1. Okay, so if I say go and I run it through this this genetic algorithm where it essentially runs through all possible combinations of the algo, and it shows me which one is the most profitable. And this account started off at $10,000, and then I run it. Okay, and just keep in mind that the entry is random. We don't care if we're buying or selling. It's a random event that triggers entries, and we don't know if we're buying or selling but before the coin flip. And so we just run this, and we're applying the algo where we're taking the profit from a winning trade to the risk of the following trade. Now let's look at the results here. Let's sort them up for the best. And so here we have $11,000 in profit based on that. And this is random, so I could do it again and those will change completely. Let's try those again. Right here we had 55, almost $56,000 in profit. So that's 560% return in 58 trades. That's crazy. That's absolutely crazy. And again, we don't care if we're buying or selling because it doesn't really matter. We are looking at a completely random event, and we are only looking at the clustering of these events in the form of winners relative to losers. And if we experience a winner, we're taking the profit from that trade, we're allocating it to the risk of the following trade in anticipation that it will be a winner. But what we're also doing is we're doing something else, and that is if you experience a winner, then you have a high probability of the next one being a winner. But this probability is not equal after the second winner as it is on the seventh winner. The likelihood of this, the seventh coin flip being tails, if previous 7 flips have been heads, is slightly lower. And so each time we experience a winner, we allocate 100%, on the next one 50%, 25%, 12.5%. Because if we are still getting heads or wins after 7 trades, I mean, a loss has to come, and so we're reducing the amount that we're willing to risk, so the profit from the previous trade onto the next trade. And so if we just run this through the tester here, and so if we look at the results, and so here you can see it work. So here we had the first one was a winning trade, so we took the profit from this one plus the initial 1%, and we risked it and we lost that trade. So that's when it worked against us. But as soon as we experience a loss, then we shut it down. We go back to the initial risk of 1%. So this is where it starts to work, when we get these streaks of winners. We have a winner. We allocate that to the next trade. You get a winner. We take a percentage of the winning trade for this one, and we add it to the risk of the following trade. Winner, winner, winner. And then we get the loser, which we expect another winner. You can see it goes down a little bit. So the first winner after the initial winner is when we get that big punch, that big almost exponential spike in the balance in our accounts, or the margin. Okay, and then it starts to go down as the probabilities of the following trade being a winner also go down. Okay, so if we look here, we have a winner. We take the profit, we allocate it to the next one, we lose it, winner, another winner, we lose. Okay, and so you can see here how this model works. Okay, you can see how we get these big rows, bim, boom. Okay, and so knowing this and leveraging only the clustering of random events, we get something like this. And this stuff is already built in to the algorithm. Here, risk. Here we have enable profit risks. Per default, it's set to false because I want people to be very careful with this, because it can also result in big losses. And here we have profit risk. This is how much we're willing to risk per trade, rather per profit on following trades. Okay. Anyway, I just wanted to show you this because I think it's really, really exciting, and I'm still working on it, and I would like to see if I can, in some way, also shut down the algo in the situation that we have a loss. So we go down, we try and go the opposite way in the situation we have a loss. And when we start to experience winners, this is when we turn up the heat and start allocating more funds to profitable streaks, as we are seeing in the results here. But I think it's fascinating. I hope you do too. And this will, in future releases, be released when it's more mature and I'm more confident in the model. Anyway, I hope you found this interesting. If you have any questions, please do let me know. And once again, thank you for watching.